When you read through annual reports or participate in business meetings where finance and accounting matters are being discussed, you may sometimes feel like you're visiting a foreign country. Owner's equity, net present value, debt to equity ratios, valuation. What does it all mean? This program and the study guide that comes with it will give you a basic conversational knowledge of the language and concepts of finance and accounting. We'll also show you how these concepts can be used in a variety of organizations, from a small pizza parlor to a major corporation. I'm Mark Mills, and I'll be your guide through this material, but the real expertise comes from two experienced members of the Wharton Executive Education faculty. Peter Knudsen is Associate Professor of Accounting at the Wharton School and Academic Director of its popular Executive Education program, Finance and Accounting for the Non-Financial Manager. He is both a CPA and financial analyst, and the recipient of several Excellence in Teaching Awards. Zahavit Joseph is Chief Executive Officer of a real estate development and construction company overseas, and has been teaching in the Finance and Accounting for the Non-Financial Manager program at Wharton since her days there as a PhD student. Zahavit has specialized in mergers and acquisitions, as well as strategic financial management. Peter will describe the key concepts of accounting, and Zahavit will explain how these tools are used to make financial management decisions. We'll begin with a short introduction to give you an overview of all of the material we're about to cover. The second section presents the fundamentals of finance and accounting. What are assets, liabilities, and owner's equity? How do they relate to one another? This will be a short review for those of you who are already familiar with these important concepts. Section 3 covers the three most crucial financial statements: balance sheets, income statements, and cash flow statements. These statements give you a picture of where the firm is and how it got there. Section 4 explores financial management. How do you make investing and financing decisions? It also delves into the effect of time on the value of money. In Section 5, we look at the ratios used for financial performance analysis: profit margins, rate of return, debt to equity. What are these ratios and what do they tell us about the company? Section 6 examines the key concepts of valuation. It shows you how you can determine the value of an enterprise. Finally, we close with a brief summary. That's where we're headed. When we're done, you may not speak the language of finance and accounting fluently, but you should be able to communicate and hold your own in financial discussions. So let's begin. And where better to whet our appetite for a discussion of financial decisions than at Angelo's Pizza. Angelo's Pizza may only have 6 employees, but the company relies on many of the same principles of finance and accounting as a Fortune 500 company. The numbers are smaller, but the financial tools serve the same purpose: to give a clear picture of how the business has performed and to provide the information for decision-making about the future. Here at Angelo's, the pizza is spicy and the profits are sweet. In fact, business is so good, Angelo's thinking about expanding. But he's not sure if it's the right thing to do, or if he can afford it, or how to make it happen. He needs to make some critical decisions. So how can the fundamentals of finance and accounting keep Angelo rolling in dough?
Well, Zahavit, the pizza business is good. We think we can sell a lot of pizzas. We want to expand. We're thinking about getting a new oven. What kind of considerations do we need to make?
I think that first of all you have to look around and find out whether there is enough demand to justify new acquisition. Once you find that out, you then have to look at the overall business objective and say, do I really want to expand? How big do I want to be? So it's two things: whether there is a demand and whether your business objectives are such that you should expand.
And if you decide that you can expand or you want to expand and the demand is there, then you have to decide what kind of ovens to get, I suppose.
Yes, this is what we call the investment decision. We now have to decide which one of possible 3 or 5 or 10 ovens to choose from. How do we do that? Well, we want to project the profitability of each one of these ovens and of course choose the one that maximizes the profitability of the enterprise.
And if we make our choice, then we have to decide how we're going to pay for this oven.
That's right, which is what we finance people call the financing decision. How do we pay for it? Do we borrow money to pay for it, or do we issue stocks to raise money and pay for it? Well, that is going to depend on the ratio of debt to equity that we want to have in our business, and it will also depend on the cost of each one of these alternatives, debt versus equity.
So on the one hand, we have the investment decisions. Should we buy a new oven? If so, which one? On the other hand, we have the financing decisions. How will we pay for our investment? Before answering these financial questions, we need first to understand financial statements, which are the tools used to make financial management decisions. We begin by introducing the key balance sheet concepts and then discuss the financial statements in more detail. Now we will take a little closer look at assets and liabilities using one of the key financial statements, the balance sheet. This will introduce you to other essential concepts that will be explained in more detail later in the program.
We're going to start with the balance sheet because that is the basis from which the other two are derived. And to get the idea of a balance sheet, think about the fact that, first of all, it balances. And let's think about it in very personal terms. Let's assume for the moment that you own your house. And if you own your house, that you have a mortgage on it. Now, what you have are, from an accounting sense, two things. You have an asset and you have a liability. Now, the asset is your house and the liability is your mortgage. And if you look at these, you can say, well, I have a house and I have a liability, but they don't balance because the house is bigger than the liability, or at least we hope it is. Now, what's the difference? It's your equity in the house. So, from an accounting standpoint, we can say your asset, the house, is equal to the sum of your liability, what you owe on it, plus the remainder is your equity. And notice, by definition, this must always balance. And if you understand this equation, you are well underway to understanding most of accounting. Now, I'm going to start with the balance sheet because the balance sheet is the source of all other statements. And as you might suspect, it balances, which means that there's a left side and a right side. So let's look first at the left side, and what do we have on the left side of the balance sheet? We have what are called assets. Now, what are assets? Assets are the financial resources of the business. In fact, they're all the economic resources of the business. Now, think of your business. What are your assets? First of all, cash. Let's list cash. And I would suspect no matter how little finance you know what cash is. All you have to do is look in your wallet or your purse. Don't look in mine because I don't have any, but look in yours. Now, what other assets do we have? We have goods to sell. What do we call that? Well, now we get into some special terminology. It's called inventory. Now, what happens if we sold some inventory, but we haven't collected it yet? Then people owe us money. What do we call that? We call that receivables, accounts receivable. So let's put in here accounts receivable. The next thing you're going to notice is that there's something interesting going on here because we're starting with the most liquid asset. That is the one that is cash or the closest to cash, and we're coming down to assets that are further and further away from being cash. Now, what's the thing that you have that's the furthest away from cash? What economic resource is furthest away? Well, it's going to be some long-term asset. It's going to be plant assets, maybe even some intangibles.
Peter's just shown us the left side of the balance sheet, the assets. In the pizza parlor, that's everything from cash to inventory like pizza sauce to the ovens and the building. But now let's look at the right side of the balance sheet. That's where the liabilities are, such as the loan Angelo took out to buy the building.
Those are called liabilities. Now, you would hope that we're not in balance yet. You would hope that one of these is bigger than the other, and I'll let you guess for a minute which one. Obviously, it's assets, right? So, what's the difference? How can this balance? Because I've got to have a total over here that is also equal to the total assets, but we don't call it total assets, we call it total liabilities and owner's equity. That's the balancing part. In other words, not only do we have liabilities, but we have owner's equity.
In this section, we'll examine the three essential financial statements that appear in the annual reports of all corporations. As we've discussed, the balance sheet is a statement of a firm's financial position at a specific point in time. It is a snapshot of a company's assets, liabilities, and owner's equity. But companies change. How do they report these changes over time? Well, let's take a look. The income statement shows us what happens over a whole year or shorter period. It is a formal presentation of all revenues and expenses over that period. If the balance sheet is a snapshot, the income statement is like a motion picture. It shows the progress or lack of progress of the firm over time. The third statement is the cash flow statement. Think of it as looking into a cash box of a small store. How much cash came in? How much cash went out? And how much cash is left? In this section, you'll learn about these three essential financial statements: how they are structured, how they are used, and how they relate to one another. If you've ever ridden a train over the last several years, chances are some of the parts were manufactured by Branco Incorporated. Their assets consist of cash and the buildings where they manufacture and assemble the parts. Their liabilities would be the debt on the buildings and equipment. Peter Knutson has the details.
In the Branco balance sheet, if we look at it, we have a whole list of assets, and you will notice that they come to a total of $76,568,000 and change. And if you look at the liabilities and shareholders' equity, you'll notice that they balance. This is why we call it a balance sheet. Now, you'll also notice something very interesting. The assets start with cash. Again, the most liquid of assets. And one of the things you're going to learn as we go along is that cash is very important. The next asset is called accounts receivable. Accounts receivable is what people owe us. But you'll notice that it's been reduced by the amount we expect not to collect. Then there's inventories. Inventories is an accounting term that means these are the things we have to sell. And you will notice as we go along, we get down to a point where there's a total current assets. These are the assets that are relatively short-term and relatively liquid. Then we have investments and we have property. If you look at liabilities, you will see that the liabilities also are classified by how soon they come due. The current liabilities start with the long-term debt that's payable within the next year and ends up with a current liability for environmental expenditures. Then you will notice a number of long-term liabilities for pensions, deferred taxes, and long-term debt. And finally, the shareholders' equity.
So that's our overview of the balance sheet. Now let's find out from Zahavit how managers use balance sheets in their decision-making.
They have to make two types of board decisions. One is the investment decision, which is the left-hand side of the balance sheet, and the second is the financing decision, which is the right-hand side of the balance sheet. Now, within the investment decision, there are decisions that I have to make on an ongoing basis. How much cash to have on hand? What about inventory? What about marketable securities? These are the short-term investment decisions. Then I have to make the long-term investment decisions, meaning what plan to buy, what asset to buy, how big of an asset to buy. These are the long-term investment decisions. On the right-hand side of the balance sheet, the financing side, I have to determine about the current liabilities, meaning accounts payable or short-term debt. And then I have to determine my long-term financing decisions, meaning my long-term debt and my owner's equity.
We've heard a lot of information about finance and accounting. But two words we haven't heard mentioned at all, debit and credit. Peter, how come?
Well, we've tried to do it without using the words debit and credit because all I mean is left and right, but they confuse so many people. Think of it this way. The only reason accountants use them is because port and starboard were already taken.
We know that a balance sheet is a statement of financial position at a point in time. But how did your business get there? To determine this, you need to look at the income statement. Remember, the income statement is not a snapshot, but more like a movie. It shows what happened over the entire year. Let's take a look.
The income statement starts with revenue and deducts from revenue expenses. Now, what do we mean by revenue? Revenue is the selling price of the goods and services that that company generated during the period and sold to customers. The expense is the cost of doing that. It's not only the cost of the goods and the services that were sold, it's also the cost of running the company and all of the expenses of being in business during this period of time. And the difference between them is the profit. Sometimes we don't like to speak about this, but sometimes it's a loss. Now let's take a look at the income statement and the balance sheet of a real company, Brenco Incorporated. On the income statement, you will see that the very first line is the sales. They're over $117 million. And you will notice there are two expenses of operating the business: cost of goods sold, administrative, and selling expenses. And underneath that, we have the operating income. That's an important number because you can relate that in analysis back to the balance sheet, because the operating income is what you've gotten from using your assets. But notice that the income is reduced because there's interest expense. That's the cost of the debt. The other thing that's interesting here is that there is a gain from the sale of assets, and that's going to be different from the cash flow. That's a profit item. It's not the amount of cash that was received from the selling of assets. Finally, and I think this is of interest because it's so common, is things that are unusual. And you might say that's a contradiction. How can something that's unusual be common? Well, it's very frequently found in reports that there are things that are sort of out of the ordinary. And this company has a special charge for environmental expenditures. And you might like to know more about that. We don't have time here to tell you more, but in a real annual report, you would go to the note. You see it says Note 8? That's one thing to keep in mind. Always read the notes because they give you the additional explanation. Finally, you will notice there are income taxes. Unfortunately, death and income taxes come to all of us. And let's hope that income taxes come first.
What do income statements mean to finance managers, and what can they find out from them?
You want to see how profitable the company is today, how profitable it has been over the past, say, 5 years. It's going to give you some sense as what's happening with the company. If you find out that this year the company did not do very well, but it is because the company invested a whole lot in research and development, you're not going to get too upset. You're going to say, fine, earnings are down this year, but that is not going to happen every year. On the contrary, they invested this year in R&D, so maybe in years to come, earnings are going to increase. So I do not want you to look at the earnings as a nominal number. I want you to look at earnings as a number within the whole picture of the earnings in the company and what's going on with the company, in the industry, and the economy as a whole.
So we've now looked at two of the three key financial statements, the balance sheet and the income statement. The third is the cash flow statement, which you'll recall we liken to a cash box. It shows you how much cash the enterprise generated during the year from its operating, investing, and financing activities.
You're going to see a real emphasis on cash flows. First of all, cash flows are divided into three categories. There are operating cash flows, investing, and financing. Operating cash flows are the cash flows both in and out that are generated from running the business, and essentially the operating cash flows are a different look at profitability. They say, how much did we actually receive in cash and how much did we pay out? Investing cash flows are the cash that is spent to acquire long-term assets, to buy our plants, to buy our equipment, to buy other companies, to acquire intangible assets, long-term assets invested in the business. It also includes the cash that we've received from selling assets, such as those. And finally, financing cash flows represent the cash that we have borrowed or received from stockholders investing in the business. So, three types of cash flows. Those that have come from the operations of the business, those that come from investing, and those that come from financing. Let's look at the cash flow statement. On the cash flow statement, you will notice in the blue type along the left edge, you have the three cash flows: operations, investing, and financing. And you will notice, interestingly enough, in operations, it starts with the income. That's the number we just looked at on the income statement. Let's go back and look at it again. You see the income was $8,801,690. That's the start. And then we have a whole series of adjustments that tells us why the cash is different from the income.
Zahavit, why is cash flow important to you as a manager?
As a decision maker, my goal is to project the profitability of any project in order to decide whether to invest in it or not. Now, I cannot use the balance sheet to make this decision. The balance sheet is a statement about the past. It shows me how much certain assets cost me in the past, minus the depreciation over time. It doesn't give me anything in regards to what is going to happen in the future. Rather than using the balance sheet, what I am going to be using is the cash flow statement. What I will want to do is to project how much cash a certain project will generate for me, how much it costs me, and how much it is going to generate over time. The cash flow statement is easy to project, and it gives us the real picture as to the profitability of that project. So I am going to use the cash flow statement in order to make my projections and in order to make my decisions. Now, when I talk about the cash flow statement, I always think about this mom and pop grocery store that I remember from my childhood. There's two mom and pop, older couple, who have this corner grocery store. And in their store, in their enterprise, everything is done on cash. When I came and bought a newspaper, they would take my money and put it right in the cash box, you know, this little cigar box. And if a supplier comes in and drops in merchandise, then they take money out and pay him. There are no accounts receivables. There are no accounts payables. There isn't anything that hasn't something to do with cash. Everything has to do with cash. All purchases, all selling, everything is on cash basis. So it's really very easy for me to evaluate how the enterprise did during the year. Because I go to mom and pop, I look at the cash box, and I count it. And then I go at the end of the year, and I count it again. And the difference is how well the mom and pop enterprise did. By the way, if mom and pop want to sell the store, then they will try to project this cash flow into the future, and they will say, well, we'll sell the store, and we will ask for it, all the potential, everything that will ever be in that cash flow from now until forever. But we'll talk about valuation a little bit later.
Small businesses like pizza parlors may have an actual cash box, but a big corporation like Branco does not. Corporations don't count actual dollar bills, but look instead at the equivalence of cash. But even though the cash flow statements of larger corporations may be more complex, the basic idea is the same as lifting the lid of the cash box in Zahavit's corner grocery store.
The cash flow statement starts with net income or income from operations. Then it adds to that depreciation, for instance.
Many people are confused by the seeming contradiction of adding depreciation amounts to a cash flow statement. So let's take a minute here to clarify.
First of all, depreciation is technically defined as the portion of the cost of plant and equipment that is allocated to each period of the asset's life. In reality, what depreciation does is spread the cost of the plant or equipment across its entire life. The depreciation expense is the part of the asset that has been used this year.
Suppose we bought an asset 10 years ago, and this asset is being depreciated every year, and every year you can take a depreciation expense of $100,000, for instance. So every year your income is reduced by $100,000, showing that depreciation expense. But remember, we did not do anything with cash this year. We did not buy this plant or this asset this year. We bought it many years ago. So from a cash standpoint, the net income is understated by $100,000. Therefore, I am adding that $100,000 or adjusting the net income by that $100,000 to show cash effect, saying if it was a mom and pop store, here's how the situation would look like in terms of cash.
This $100,000 adjustment is made to accurately reflect your cash position, and it's one of several adjustments that are made to income on the cash flow statement.
So there you have it, the three essential financial statements which allow you to assess the financial situation of your firm today and project it into the future. The balance sheet, a snapshot showing where the company is at a specific point in time. The income statement, a motion picture showing the profits generated over a period of time. And the cash flow statement, like a cash box, showing changes in the cash position of the company. Now let's take a break, and then we'll look at how you can use these statements in managing your business. You need to be able to do more than read financial statements. You have to be able to use them to make decisions. In this section, we'll look at how you use the tools of finance and accounting to evaluate business options.
Well, Zahavit, we've learned about the basic accounting statements. Now, how do we use those to help us make decisions about our business?
Well, in general, we make two broad decisions in finance. And we use these accounting tools, this balance sheet and income statement, to help us understand the past and therefore project the future. Let's talk about investment decisions and financing decisions. Before we do that, I have to talk about the principal technique used, which is the present value technique. Well, to illustrate the present value technique, suppose I have a deal for you. I am going to ask you to lend me $1,000 right now, and I'm going to return this $1,000 in 10 equal annual installments of $100 every year for the next 10 years. So you give me $1,000 right now, and I will return it 10 years, $100 every year. You gonna take this deal?
I don't think so. I get my $1,000 back, but it takes 10 years, and in the meantime, you've been able to use my $1,000. So I don't like that deal.
Okay, how about if I give you $102 every year for the next 10 years? Will you give me $1,000 right now?
Well, it still doesn't sound very good, but I'm not really sure why.
Okay. The most basic concept in finance is that we can never, ever add up cash flows that are not in the same period. Why? Because $100 that you're going to be getting in a year from now is not worth $100 that you're going to get 10 years from now. $100 in a year from now is worth much more than $100 10 years away. So we cannot add up these cash flow and say, well, 100 plus 100 plus 100, that's 1,000, so it's a fair deal. What we have to do is find a way to bring all of these cash flows into one period. Then we can add them up. They're all in the same period. So what the present value formula does for me is that it allows me to find the present value of each and every one of these future cash flows, bring them all into the present, and then add them up. Compare it to the investment, in your case it's the $1,000, and decide whether it's a good deal or bad.
According to the calculation Zahavit taught me, if she pays me $149.03 every year for the next 10 years, then we have a fair deal. When I convert each of these future cash flows into the present and add them up, the present value of these inflows equals exactly $1,000.
Until now, we've been talking about considering one deal at a time, but in business, these decisions are more complex. So let's take a look at how this approach is used to analyze several different options. This is the capital budgeting process.
Well, Zahavit, you're the head of a construction company, and it has different divisions in it with managers of those divisions. And they may want to take on projects, so they'll come to you and say, I have a great idea for a project. It's going to cost this much. How do you decide whether or not to go ahead? How do you know if it's a good deal for your company?
Well, the first thing I do is, obviously, I ask them for a business plan. What is it exactly that you intend to do with this money? And in that business plan, they will come up with some projections as to the inflow of that project. They'll tell me how much it's going to cost and cash inflows of that project. I'm going to then look at these projects, and we'll have to decide which one of them to choose. Scarce resources, more than one project. Which one do I choose? That's the capital budgeting decisions that I have to come up with.
Decisions about where and whether to invest come under the heading of capital budgeting, defined as the process of planning expenditures on assets whose returns are expected to extend beyond 1 year.
Let's look at an example. Suppose my construction manager, the manager responsible for the construction subsidiary, comes in and says, well, listen, I would like to invest $1,000 in this equipment, and this new equipment will allow us to generate this cash flow over the next 3 years. That's a cash flow above and beyond what we would have otherwise gotten. So I'd like to invest $1,000, and investing that $1,000 will result in $200 extra in the first year, $200 extra in the second year, and $600 extra in the third year. Suppose my concrete manager comes in and says, well, I want $1,000 too. I want to invest it in this new concrete equipment that is going to produce these cash flows. Now I have to look at these two projects and decide which one to choose. I have only $1,000. One technique that we look at when we talk about capital budgeting is what we call the payback period. How fast do I get my money back? Well, let's look at it. In the first project, I am spending $1,000, getting back 2, 2, and 6. That means that it takes me exactly 3 years to get my $1,000 investment back. So here, the payback period is 3 years. How about the second project? How fast do I get my money back here? Well, it takes me 1, 2, 3 and a quarter years to get my money back. So if we use the payback period, we see that it takes me less time to get my money back if I invest in the first project. Now let's look at it logically. Would you want a deal like that? You give me $1,000 right now, and I will give it back in the first year, $200, second year, $200, third year, $600. Does it make sense?
Well, I get my money back, but there's no profit in there, so I'm not wild about that one.
So the payback period you're saying doesn't take into account the time value of money. We are adding cash flows that are not in the same period. And remember, we said that that's one thing we don't do. We cannot add up cash flows that are not in the same period, because then we don't take into account time value of money.
So is the payback period useful at all?
Well, if we use the other techniques, which we are going to talk about, the net present value and internal rate of return, and we find that the net present value and internal rate of return of projects are very, very close, then we might want to use the payback period. But by itself, it is not very useful. As we saw, it does not take into account the time value of money, and it also doesn't look at all cash flows from now until forever. And I want to look at the whole picture. Let's look at another project. For instance, my quarry manager comes in and he says, well, I want $1,000. I would like to invest it in the quarry, buying equipment for the quarry, and here's what we are going to generate from this investment. First year, we are going to generate nothing because we are still learning how to use this equipment. It's going to take us a year. But after that, year 2, we are going to generate $200 above and beyond what we would have otherwise generated without this capital investment. In the third year, 400, 300, 500, and 500. And that's it. Now looking at this project, I'm saying, what is the payback period? How fast do I get my money back? Well, it takes me 1, 2, 3, 4.2 years to return my investment. Now let's look at it. Let's compare project number 2 with project number 3. Project number 2 has a lower payback period, meaning I am going to get my money back faster. But look at how much more cash I am getting from investment 3 after returning my investment back. As a matter of fact, we have another technique that is called the net present value technique. That technique takes into account these two things that the payback period doesn't take into account: time value of money and cash flow from now until forever. Net present value is the net of two present values. It is the net of present value of the inflows minus the present value of the outflow. So what we do here is that we need to find out what is the present value of the inflow and compare it to the present value of outflow. Well, we know what the present value of outflow is in each one of these projects. It is how much it costs me right now to invest in these projects. Let's look at project 1, for instance. The present value of the outflow is that $1,000. How about the present value of the inflow? What is that? Well, we need to find that out. How do we do it? Well, we find out, first of all, the present value of this $200 that is going to be generated in year 1. It is 200 divided by 1 plus interest rate, which we are going to assume for now is 8%, but later on we will talk about it, taken to the first compounding period. Adding to that the present value of the second cash flow to the second power, and adding to that the present value of the third cash flow. Adding all of these together, we find out that the present value of the inflow is $833. What does it tell me? It tells me that if I am investing in this project number 1, in terms of today's money, what I am getting is $833. But wait a second. I just invested $1,000 in this project. Do you still want to take it on?
Doesn't sound like a very good deal to me.
That's right. The net of the inflow and outflow is negative. Net present value is negative. If it's negative, we don't want to touch it. We want to look only at these projects that have net present value equal to or greater than 0.
Okay, and how do these projects compare if you were actually faced with this decision?
Well, as a matter of fact, I look at the net present value of each and every one of them. It turns out that the net present value of project number 1 is, of course, negative. It is $167 negative. Project number 2 has positive net present value of $74, and project number 3 has net present value $365. So when you look at the net present value, we have a totally different picture than when we looked at the payback period. The payback period said, well, project number 1 has the shortest payback period, therefore we should choose it. The net present value is showing us if we take into account the time value of money and we look at all cash flows from now until forever, then really project number 3 is the most profitable one. In terms of today's money, I'm investing $1,000, and in terms of today's money, I am receiving $365 more than I invested. You see, when we were looking for the net present value, what we did is we looked at the present value of each of the future cash flows, add them all up, and then compared it to the present value of the investment. Now, when we did that, we assumed a certain interest rate. We assumed an 8% interest rate. When we are looking for the internal rate of return, what we are looking for really is that interest rate. that I, that we assumed it to be 8%. Now I'm asking, what is this interest rate or internal rate of return that I am getting by investing in each one of these projects? Well, how do we find the internal rate of return, that I? What I say is, let me equate the present value of inflow to the present value of the outflow. This way I can find out. Well, how can I do that? Well, I know that the outflow is $1,000. And I know that the present value of inflow in this case, for instance, is 400 divided by 1 plus that I that I'm looking for, plus 200 divided by 1 plus I to the second power, plus 300, 1 plus I to the third, and 400, 1 plus I to the fourth. I am looking for that I now that is going to make the present value of the sum of this equal to the present value of the outflow. That I is the internal rate of return. So I looked at the payback period. I looked at the net present value, which is the dollar amount in terms of the present value of the inflows and outflows. And now I also look at my manager's internal rate of return on each one of these projects. And I find out that the internal rate of return on the first was negative. So it's non-available. On the second project, it is 11.3%. And on the third project, it is 16%. And as you can find out, the project that gives me the highest net present value gives me the highest internal rate of return, which makes sense. In terms of dollar amounts, I am getting the most in project 3. And also in terms of the interest I'm getting on this project, I am getting the highest internal rate of return by investing in project 3.
Would different companies have different rates of return, or maybe different rates of return within the same company?
Absolutely. The required return, or the interest rate, or I, or sometimes referred to as the discount rate or hurdle rate, depends on the risk-free rate, how much you can get for your CD or treasury bill, and it also depends on the risk of that project. The riskier the project, the higher your required return is. And you remember, they always talk about risk and return. The riskier the project, the higher the required return. So this interest rate that we decided on has to do with the risk-free rate and the riskiness of that project.
We've been talking a lot about how to place a value on assets that we might want to acquire, but we also have to deal with the question of how to finance those acquisitions. What kinds of considerations do we have there, Zahavi?
Well, I guess in general we have to think about two considerations. One, how much debt to total capital we want to have in the company. And second, the cost of debt compared to the cost of equity. In other words, we first of all have to decide how much long-term debt compared to our total capital, long-term debt and equity we want to have. This is what we call the capital structure. And second, we have to find out how much does it cost me to issue debt versus to issue equity.
And how can using debt help us in our business? They call this leverage. What do they mean by that?
When we issue debt, the interest we pay on the debt is deducted for tax purposes. Therefore, the debt is cheaper than equity. So first of all, we want to have some debt because debt is cheaper. That means that more money is going to be left in our cash box. However, you have to remember one thing. Debt is cheaper up to a point. So I do want to take debt, but not too much. There is that point which is the optimum. After that point, I don't want to take any more debt because my chance of bankruptcy goes up, and therefore the cost of debt goes up, and therefore the cost of equity will go up.
And what are the ultimate benefits of leverage if it's really used to the maximum effect?
Well, I guess you can look at it from a leverage buyout standpoint. When you look at leverage buyouts, you find out that, first of all, you use less of your equity, meaning you're taking less risk, and usually you pay less tax because you have such a big interest that you have to pay the debt holders.
Zahavi, can you give us an example of how we might use leverage in our own personal finances?
Yes, as a matter of fact, we do it in our personal lives all the time. For instance, when we buy our houses, we put down not 80% equity, but rather only 10%. We use the rest, 90%, leverage, debt. The power of leverage is such that if this house that is worth $100,000 increases in value to $200,000 and we put down only $10,000, our return on investment is the $100,000 that we made divided by the $10,000 that we invested. We made 10 times on our money. Let's remember that leverage goes both ways. If this house goes down in value from $100,000 to $50,000, then not only we have interest to pay on $90,000, we also need to come up with extra $50,000. This is our loss.
So we've looked at how you use finance and accounting to make business decisions. We've talked about investment decisions, capital budgeting, payback period, net present value, and internal rate of return. We also looked at financing decisions, capital structure, the effect of leverage, cost of equity, and cost of debt.
Some financial management decisions require you to examine the financial performance of an enterprise. In the next section, we'll cover financial performance analysis. Snapshots and movies don't always tell you what you need to know about the health of a company. Sometimes you need to look deeper at the vital signs of a company. These vital signs are the performance ratios. They can tell you how your firm is doing or assess the health of a firm you intend to acquire or invest in.
Ratios fall into 4 categories: liquidity, efficiency, solvency, profitability. Let's look at a few of the key ratios in each of these categories.
And the ratio that we're going to look at here is not the only one, but it is perhaps the most commonly known financial ratio. It's called the current ratio, and it is calculated by dividing current assets by current liabilities. And you will notice that from the balance sheet data, we can do this for each of 2 years. And it's important to look at more than 1 year and to look at the ratio. It's a very commonly used ratio. And what are the numbers for Brenco?
For the current year, it's 5.6, and for the preceding year, it was 4.8.
Okay. Now, what that means is, first of all, in this year, at the end of this year, Brenco had $5.60 of current assets for every dollar of current liabilities. Last year, they had $4.80 of current assets for every dollar of current liabilities.
And that's an improvement, so is that good news?
It could be and it might not be. And let's look at it this way. Liquidity is always good, except you could be too liquid, couldn't you?
Have a lot of cash sitting around idle.
Yeah, think about that. In fact, the most liquid company would have nothing but cash, and it would just sit there, wouldn't earn anything, right? So being too liquid is wasteful, but what happens if you're not liquid enough?
You can't pay your bills.
Yeah, that's fatal. So you have your choice. You can be wasteful or fatal, and you have to find the middle ground.
And again, in trying to decide whether this is a good ground for these folks, if this is a good middle ground, how do we get a sense of that?
Well, what we look at is other companies in the industry. In fact, industry studies are published by organizations such as Dun & Bradstreet. In the United States, the Bankers Organization, the Robert Morris Associates, publishes annual statement studies. We compare to ourselves, but we also want to have financial plans and goals of our own.
Efficiency ratios show how well a company uses its assets. Let's start with inventory turnover. How does that work?
What we're going to do is we are going to relate the cost of goods sold for the year to the inventories that we held during the year, and theoretically we ought to do an average of daily inventories, but we're going to average the beginning and ending. That's why the inventory turnover ratio is the cost of goods sold divided by the average inventories, which is the beginning inventory plus the ending inventory, added together and divided by 2.
Now further down there, we see a solvency ratio. What does that tell us?
Well, actually, I have 2 solvency ratios here. And there are many others, and there are variations in how you do these. The first one is the ratio of debt to equity. And that's very easy to explain because what we do is we divide the long-term debt by the stockholders' equity. That gives us an idea of how much debt we are carrying supported by how much stockholders' equity. For instance, for Brenco, what is the number?
The current year is 19.7%, and for the year before, it was 20.7%.
Okay, that means we have $19 of debt for every $100 of equity. That seems to be a very strong equity base. In fact, one might even say, why doesn't Brenco have more debt and perhaps trade on the lower interest rate of the debt and use what we call leverage, using low-priced debt to invest in high-priced returns, so we earn a higher rate of return on our assets than we have on our debt, and the benefit goes to the common stockholders. That's what leverage is, or as they call it in the United Kingdom, gearing.
Because a lot of people's reaction is, well, the debt's real low, so that's good, that's safe, but that may not be the best thing for the company.
That may not be the best thing. On the other hand, it may be for this company. Remember what business it's in. What is it? It's industrial manufacturing. That means it is probably going to react much more to the business cycle than, let's say, your supermarket. Because put it this way, people eat during recessions. They don't always buy tapered roller bearings for their railroad cars.
What about interest coverage?
Interest coverage looks at debt from the standpoint of the cost of the debt. And what we're going to do is we're going to take the earnings before interest and taxes, and we're going to see how many times we earn our interest. And the reason we do it before interest and taxes is obviously you've got the income before the interest to pay the interest. You wouldn't look at it after the interest. And the interest is tax deductible, so we don't have to pay any taxes until we've taken the interest out. So we look at the earnings before interest and tax and divide by the interest expense and say, how many times have we covered our interest?
Our final category of ratios is profitability, the most important one of all.
Well, with profitability, this is what it's all about. If you don't have profits, you shouldn't have tried doing it in the first place. Now, the first one, profit margin, relates strictly to the income statement, and that says how much of your sales dollar ends up as profit to the stockholders. And what we do is we divide the net income by the net sales and compute a fairly simple percentage. And for Brenco, what's the percentage?
Brenco had 7.5% profit margin.
Okay. Now, we really don't have a way to evaluate that without making a lot of comparisons, as I said, with other companies in the industry and with the same company for different years. But let's look at industries. For instance, you hear in supermarkets that the profit margins are razor thin. And you would expect in a supermarket that the profit margin would be perhaps 1% of sales. But we're going to deal with that in a few minutes, so let's leave the profit margin for the moment, and let's go on to the return on investment. And I have 2 different returns on 2 different investments here, the return on the assets and the return on the equity. Return on assets says, what are we making in this firm on the assets that have been given to us to work with, regardless of their source? And in this case, because it is before we consider debt financing, we once again will take earnings before interest and taxes, and we will divide by the average total assets. And this will give us some idea of how well we're earning on those assets. For Brenco, what is the percentage?
Brenco had 21% return.
Now, 21% isn't bad. It's better than what you get on your statement savings, isn't it?
Quite a bit.
It's better than you get on a lot of things, isn't it? But remember, this is a cyclical company. Next year, it may be 0% or minus 5%. When you invest in these sorts of things, you're taking risks. And so you've got to take that into account. Don't go emptying your bank accounts and putting it into common stock without looking at what you're doing.
And how is the return on assets different from the return on equity?
Well, a return on equity focuses on what the stockholders are earning. And there are two differences because, first of all, we're using net income. That means this is an after interest and an after tax number. And we're going to divide by the average investment of the shareholders. And notice that the numbers here are lower than they were for the return on assets. What was the return on shareholders' equity?
17%.
17%, because that represents the reduction for taxes.
Remember, all the ratios work together. Liquidity is a measure of the company's ability to pay its debt. Efficiency tells you how well the assets are being used. Solvency shows us the way we use and carry debt. And profitability tells us how much of our sales dollar results in profit and what is the return on assets and shareholders' equity.
That's our summary of ratios. Remember, don't focus too heavily on any single one of them. Ratios can vary widely between industries and even among firms within the same industry, but they are useful in an overall analysis. If you want to learn more about them, check the study guide. For now, let's take a break and we'll come back with a discussion of valuation.
Well, Zahavit, you've shown us how to do a net present value of a proposal for buying some equipment. What if somebody wanted to value a whole company that they were thinking of acquiring?
Well, as a matter of fact, valuing a company or a unit or a subsidiary within a company is done very much in a similar way to the way we valued a project, the capital budgeting projects. We use the free cash flow valuation technique. What we really do is we find out how much money is left in that cash box, mom and pop cash box. We find out how much is left in that cash box after every year. So we project free cash flows for every year, starting now until many, many, many years from now. As a matter of fact, forever. We project all of these free cash flows. And again, free cash flow is the money that's left in the cash box that is available to the providers of capital. This is money the company can do whatever with. They can pay off their debt, they can pay shareholders, or they can put back in the company. First thing we do is we project these free cash flows from now until forever. Then we use our technique, the present value technique, the net present value technique, to bring all of these free cash flows into the present. Add them up, and this is the value of that entity.
What kind of decisions can we make using this valuation model?
This valuation model, which by the way is called the economic approach of valuation or the discounted free cash flow approach, is used for mergers and acquisitions. Restructuring, suppose you want to sell one of your units. How much should you ask for it? It is used for when we go public. How about the stock price? It is used for strategic planning. In our capital budgeting, for instance, we have many projects. We project each one's free cash flow, come up with value for each one of this project. And so for strategic planning purposes, I'm going to choose one of these projects, the one that gives me the highest net present value.
Besides investment decisions, what other way do you use this valuation technique?
I can use that for profit plan targets, resource allocation, and of course compensation. I will compensate my managers based on how much value is being created by the company.
These cash flows must be discounted to reflect the costs of debt and equity. This is done by using the discount rate. Zahavit explains.
Well, the discount rate we use is a function of the riskiness of that company, or really it's a function of the cost of debt of that company, the cost of equity, and the proportion of debt to equity that is used by the company, or what we call capital structure. So the I we use here is called the weighted average cost of capital.
So if we had a capital structure that was 50% equity and 50% debt, and say the equity portion cost us 12% a year and the net debt portion cost us 8% a year, our weighted cost of capital would be 10%?
It is 50% of the 12% plus 50% of the 8%, which is 6 plus 4, 10%. So the I will use to discount these future cash flows will be 10%.
All right, so we're going to discount by 10%, and it's got to come back and equal more than whatever it is we're paying for the asset then, to have a positive value.
This is the value of that asset. The value of this company, subsidiary, unit, project, is the present value of all of these projected free cash flows discounted by that I that we determine makes sense for that company.
So we've been talking about valuation. To come up with an accurate value for a company, unit, subsidiary, or project, we have to do two things right. One, correctly project free cash flows, and two, determine the appropriate discount rate to be used.
The value of the company or project is the sum of the present value of the projected free cash flows discounted by the appropriate discount rate or weighted average cost of capital. Well, that is an overview of some of the key concepts of finance and accounting. Let's look at what we have learned. We started at Angelo's Pizza, where we examined a few key concepts including assets, liabilities, and owner's equity. Then we headed out to Branco, where we looked at the three primary financial statements. You remember, the balance sheet is like a snapshot, the income statement is like a movie, and the cash flow statement is like looking into a cash box. Next, I learned that $1,000 isn't always what it seems to be, and I also learned not to make deals with Zahavit. We explored net present value and saw how managers use NPV and IRR to choose among competing projects. Then we looked at key ratios that are used to evaluate companies. And finally, we looked at valuation. We saw how the discounted free cash flow method can be used to determine the value of a company or project.
And so we come to the end, at least the end of the beginning. If you're ready for the next stage, there are two steps you can take. First, you can continue working through your study guide, which will give you additional examples and explanations. And second, you can begin to apply these concepts and terms in your work. Like any new language, it may not feel completely natural at first, but it is only by using it that you truly learn it. Soon, you'll be speaking like a native. Good luck. I'm Mark Mills.